Okay, why Volvo Car Belgium is a good company to invest in? We used 4 ratios and stock market to determine this. I'm going to begin with the ratios. The solvency rate or the solvency ratio, this needs to be at least 0.25 or 25%. That shows us how much debt is covered by equity. If it's above 0.25 or 25%, they have a good solvency ratio, but Volvo has an average of 0.17 or 17%. This means that they need a lot of investors to cover their costs because they have more debt than equity. The ROE and the ROA. The ROE shows us how profitable a company is. Like you see on the graph, Volvo is very profitable. This ratio needs to be at least 0.5, 0.10, which it is for the 3 financial years. And in the last years, it's even more than 0.5. It's above 1, which shows us that in the 2020, Volvo is very profitable. The ROE shows us how efficient the company uses its equity. This needs to be at least 4%, which it is for the 3 financial years. But we can also see a decrease in the ROE from 2018 to 2020. This can be due to Corona, but we are not sure. Then the liquidity. We used a quick ratio to determine the liquidity of the company. The liquidity needs to be at least 1, which it isn't for Volvo Car Belgium. It's under 1. They have an average for the 3 financial years of 0.74, which shows us that the company have difficulties to repay off their debt short term. Now the stock market. You can see that the price per share went from $90 to 55. It dropped it down to $55 per share, which is not good for the company, but it's ideal for new investors that want to invest in Volvo Car Belgium and Volvo Car AB, the mother company of Volvo in Sweden. So, like you see, it's a big decrease. This is due to the shortages in the production line due to Corona and the war in Ukraine. So, to conclude, I think Volvo is a very good company to invest in because they have a very good ROE and ROA. So they're very profitable and use their equity wisely. And the price is very low for one share. So it's the perfect moment to step in, I think.